Thank you very much for joining this morning. Bore da, a croeso I Gweminar, Awdurdod Cyllid Cymru and a Papur Gwyn Bil Cynnal Treth Cymru. Thanks for joining our webinar on Welsh Government's public consultation on Wales's first tax maintenance bill. I'm Claire and I'm Head of Stakeholder Engagement here at Dua, who's our Head of Policy and Strategy at Welsh Revenue Authority. We will be recording this session, so if you don't want to be on camera, please do go off camera. And we'll also be sharing these slides with you after the webinar with a little bit more detail in an email. So this purpose of this session really this morning is it's an information sharing webinar, and due to the technical nature, rather than take questions today, we'd like to arrange one-to-one meetings in January to delve into discussion on some of the proposed changes to the Welsh Tax Acts and then answer any questions you may have. And hopefully this will inform your responses then ahead of the closing date on the 26th of January next year. Seems a long way away, but as we know, it soon is upon us. So this is basically what we'll be covering in the next 45 minutes to an hour. So in brief, I'd like to just give an introduction to Welsh Revenue Authority. Some of you will know a bit about us, others may not know much at all. And then I'll hand over to colleagues who will cover the tax maintenance bill and then also the white paper proposed changes. So we'll do that. So a little bit before we get started about Welsh Revenue Authority. So we are a non-ministerial department of the Welsh Government and we were established back in 2017. We're responsible for collecting and managing devolved taxes in Wales, including land transaction tax and the landfill disposals tax. And some new responsibilities are since September this year. They are that we are now responsible for establishing and maintaining the visitor accommodation provider register and overseeing the collection and management of the visitor levy as and when local authorities across Wales opt in. But our purpose is to design and deliver Welsh National Revenue Services and to lead the better use of Welsh taxpayer data for Wales. The money, as you know, we raise, it provides vital funding for Welsh communities and public services such as schools and the NHS. We are committed to working in partnership with taxpayers, representatives, local authorities and the public to ensure taxes are collected fairly, efficiently and transparently. Our approach, which I'll touch on shortly, is defined by collaboration, reliability and a commitment to helping people to get things right the first time. We are very proud of our innovative, inclusive and highly engaged team, and we strive to make it easy for everyone to do the right thing. And on the next slide, a little bit about our approach, and if you've been to any of our events before, you most probably will remember this. So as we mentioned, we help to deliver a fair tax system for Wales through our approach, and it's a Welsh way of doing tax. And working with yourselves and taxpayers, we want to make sure that we believe in supporting taxpayers and stakeholders to do the right thing the first time. And so we're here to offer guidance and support. And as a digital first organisation, we provide excellent services, which is at the heart of our work. And our approach is defined then by three terms. So cydweithio means working together and carries a sense of working towards a common goal. Cadarnhau then suggests a solid, robust quality that can be relied on. This is about providing certainty, being accurate and reinforcing trust through the services that we offer. And the cywiro, which literally means returning to the truth, and is about the way we work with you to resolve any errors or concerns. Our approach is also inspired by our charter, which explains a little bit more about how we work. And if you're interested in any of this, there's more information on our website about our approach, and you can access our 3-year corporate plan as well. I'm going to hand over to India now, who's going to delve into the detail on the bill, which is what I'm sure you're more interested in, and then I'll see you at the end of the webinar. So, diolch yn fawr iawn. Over to you, India.
Diolch yn fawr, Claire. Good morning, everyone. As Claire said at the start of the meeting, my name is India Hitchin, and I am the lead for legislation and strategy at DCRhT. So, the tax maintenance bill. It's a new way, it's the first time that we're doing something like this here in Wales. So it's going to be a new way of doing tax administration. And it's designed, the way that we're proposing to do this is designed to emulate the finance bill process at UK level. So the proposals in the white paper are intended to inform discussions and form the basis for a bill related to maintenance matters. So, it's intended to update legislation based on current UK case law, best operating practices, and to future-proof the legislation. So it's a sign of a maturing tax collecting nation to produce certain bills like this, and one that we're proposing in the white paper. And what the white paper intends to inform readers is that over time, practical experience has shown us in the 8 years that we've been operating now, that there's certain aspects of the legislation underpinning each of the devolved taxes and the operations of WRA itself that are in need of refinement. So the consultation contains a package of proposed changes to the Welsh Tax Acts, and they are the Tax Collection and Management Wales Act 2016, which is our piece of foundational legislation that contains all of our provisions relating to our governance and our functions, and how commonalities between all the taxes that are administered in relation to things like penalties and inquiries, determinations, and your normal tax administration powers. And then there are 2 pieces of legislation related to specific taxes, those being the Landfill Disposal Tax Wales Act 2017 and the Land Transaction Tax and Anti-Avoidance of Devolved Taxes Wales Act 2017. So the amendments outlined in this consultation are drawn from 7 years of operational experience, as I said, in relation to collecting and managing devolved taxes. And they've fed in feedback from industry representatives, our Welsh public service partners, and are in response to kind of relevant UK government legislative changes, as we'll explore in the next few slides. And the technical changes are intended to clarify, enhance, and future-proof the Welsh Tax Acts and enable WRA to continue to collect taxes as effectively as possible and to support that wider public service delivery in Wales. So this will be for the next Senedd term and a future Welsh Government to decide whether or not they take forward. So whilst we've outlined what the purpose of the consultation is, there's further areas beyond the consultation that will fall with the next Welsh Government to consider, and it'll be for the next government to choose to move forward with the proposals. And should they move forward with the proposals, they will of course undergo a full scrutiny process as primary legislation. Okay, let's move on to the first the consultation then. So look at that. Published our white paper, accompanying written statement and draft integrated impact assessment on the 3rd of November of this year. And that was to coincide with our stage 2 budget announcements. That's quite common at UK level. Papers such as these are often tied to the fiscal events, so the publication aligns to that. And so we decided to do that in this case as well. If it ain't broke, don't fix it. White papers are policy documents produced by the government to set out their proposals for future potential legislation, and so that's exactly what this paper is intended to cover. And the consultation closes on the 26th of January 2026. So members of professional bodies on the call, if your organisations are intended to produce a response to that consultation, there's still plenty of time. And as Claire mentioned at the start, if having further conversations with myself and Joe and WRA members would help to assist in the development of those documents, then we're more than happy to facilitate those further conversations. So there's 16 substantive themes for changes proposed in the paper. And some of them are changes that would be macro, so related to the Tax Collection and Management Act, as I mentioned, that are going to impact the operation of all taxes administered by the WRA. These are things such as WRA's governance, aims to align our interest rates to HMRC's for late payments, and changing our powers relating to withholding repayments when, without having to open an inquiry. But there are also, later on in the white paper, there are proposed technical changes that will impact the operation of landfill disposal tax and land transaction tax. So today is very much a whistle-stop tour of the proposed changes. And as Claire said, again, we're going to provide our inbox at the end of this webinar, should anybody be interested in further discussions. Great. So let's talk about the first change. So the first theme for changes is related to WRA governance. So two changes in this section, proposal 1 of the white paper, and I won't spend as much time on these as these are more clarificatory in nature, kind of following advice on some disparate legal risks rather than representing a major change to the way that WRA currently operates. So a bit of background. When WRA was first set up, WRA governance was designed to follow best practice across Wales, so that being a board with a non-executive chair and a majority of non-executive members. And this was designed to kind of align with Wales's broader governance structures in spaces such as health and education. But interestingly, it doesn't align to the way that HMRC and Revenue Scotland's governance structures work. So one issue with that is, one reading of the legislation is that all committees exercising WRA functions require non-executive membership and only WRA members can vote. Problem with this is it risks non-executive members being drawn into day-to-day operations, which wasn't the intention. It kind of undermines the board's function as kind of having an oversight role and its governance integrity. And there's an issue about non-executives, so not civil servants, engaging in executive government functions. So, as I said, this is more clarificatory rather than something that's actually happening, but the proposed TCMA amendment is for the board to be able to decide which committees and subcommittees of WRA that require non-executive membership, obviously decisions being recorded. And then also a supplementary issue that we found is with non-members obtaining clarity as to which groups that they can vote in and which committees and subcommittees they can vote in, except quite pivotally the Audit, Risk and Assurance Committee and the Remuneration Committee. So that's that one. So let's move on to change 2. So change 2 and proposal 2 in the white paper relates to WRA's information sharing powers broader than our ordinary kind of functions as ascribed to us in TCMA. So there are 2 potential changes that are mooted in the paper that discuss our, they surround kind of the data that WRA collects has utility for other functions outside of our own. So with both the proposals in the paper, the intention is that we have data that could potentially feed into a broader taxation and policy ecosystem. And there's a potential to explore having a more joined up approach when it comes to tax compliance and improving public services in Wales. We're quite keen to align our data sharing principles to broader ones that HMRC have in this space and align and be able to utilize WRA's data in this kind of broader government data utilization initiatives where it would be appropriate to do so in kind of restricted circumstances. But it's probably worth saying off the bat with the 2 changes that I'm going to explain. Insofar as is possible, the intention is very much still that this is aggregate information that would be shared. But as is explained in the white paper, one of the interesting quirks of our legislation when it comes to what is and isn't considered confidential information in the HMRC space, protected taxpayer information for us, is due to a lot of the times the small numbers of transactions that relate to a specific matter. Even if data on the face of it looks like it's aggregated appropriately, by virtue of the small numbers, there's a possibility that somebody's identity could be deduced, which would also mean there's protected taxpayer information. So that's where the challenges come in this space for us that don't really exist at HMRC level because the numbers you're talking about are so much bigger. So let's talk about the local authority gateway then. So the intention behind this would be that WRA will be able to share information with local authorities for the purposes of administering local tax, so council tax and non-domestic rates. This is a highway that exists at UK level between HMRC and local authorities in England and Wales via certain legislative legislative mechanisms such as the Local Government Finance Act. And the intention would be to give us parity there, so that the information DCRhT holds, for example, with our land transaction tax returns or visitor levy data, potentially could be shared in bulk to local authorities to assist in determining whether a matter is, say, residential or non-residential for non-domestic rates or council tax purposes. And then moving on to the research gateway, for matters that don't fall within Welsh Government's ordinary functions, as ascribed by the Government of Wales Acts and the Wales Acts, so supralegal functions, there's a possibility that, again, that what would on the face of it be aggregate data, we have found in practice, because of the small numbers we're talking about, we're unable to provide certain types of data for matters such as forecasting and research, that if there was, a softening of the wording in TCMA, that we would be able to assist further, and it would lead to, better governance and decision making on those matters. As it says on the slide, we're very much, this is a collaborative policy. This is something that DCRhT is developing in isolation. We are engaging with the Information Commission's Office on this matter to ensure that the proposals align with data minimisation principles and UK GDPR and the Data Protection Act, and we'll continue to engage with local authority partners and Welsh Government on this. Great, so change 3. So, you may have noticed there was a piece of primary legislation that came through this year, which was the Visitor Accommodation Register and Levy Act 2025, which we refer to as VALA, which gave DCRhT powers in relation to setting up a national registration service for visitor accommodation providers in Wales, as well as, should local authorities choose to switch on the powers, administer the visitor levy on their behalf in those local areas. And one of the changes that impacted more broadly DCRhT's governance was that piece of legislation gave DCRhT powers that are comparable to HMRC's information sharing powers for the purposes of their functions. So Section 17 and 18 of the Commissioners of Revenue and Customs Act 2005. So what that's meant is that DCRhT are now able to share PCI with persons in accordance with their functions, which means, for example, things like during an inquiry, we're now able to discuss data gathered with a taxpayer directly without having to recommend that they appeal matters to the tribunal just so we can discuss things. It really was quite a prohibitive omission in our legislation that has now been rectified. One restriction on this, what we call a general functions gateway, was in relation to functions that TCMA, VALA amended TCMA to allow DCRhT to provide information, assistance and advice relating to visitor levy to principal councils. So that was a specific function that was given to us in VALA. And because that's one of the restrictions on this kind of general functions gateway, it means that DCRhT isn't able to share information with local authorities for our visitor levy functions, which, seems quite niche and restrictive, but what that means is that we don't have parity with the devolved taxes in that space. So say during an inquiry into a land transaction tax return, the disclosure is for the purposes of DCRhT's LTT related functions. DCRhT would be able to ask a principal council, local authority, if a named taxpayer is, say, a non-domestic rates payer, for example, in order to help DCRhT assess whether the tax has been paid correctly. And the problem is that we don't have parity with visitor levy, so we can't do the same thing. Say if visitor levy return comes in, seems suspiciously low, so we open an inquiry, we can't ask principal councils for that information. So this amendment is much more about giving the local tax that we're administering on behalf of local authorities that same parity with the devolved taxes. So you're probably sick of hearing my voice now, so I'm going to pass over to Joe Dewar to talk you through the next few slides.
Lovely, diolch India, thank you India. So as Claire mentioned in the introduction, my name is Joe Dewar. I'm Head of Strategy and Policy at the WRA, and I'm going to take you through the next few slides. Before we get into this change, it's worth saying, just in the interest of time, I'll refer to the Land Transaction Tax Act as the LTTA, the Landfill Disposals Tax Act as the LDTA, the visitor levy legislation as VALA, and the Tax Collection Management Act as the TCMA. There'll be phrases I'll be using quite a lot over the next few slides. So let's start by looking at repayments during an inquiry. So as you're probably aware, Land Transaction Tax and Landfill Disposals Tax Act are self-assessed taxes. That means taxpayers calculate and report what they owe themselves. And when a taxpayer requests a refund by amending their return, the repayment is processed automatically. Now, this works well most of the time, but there have been cases where it would be prudent for the WRA to withhold repayment while an inquiry into that amendment is ongoing. For example, if an amendment is flagged as high risk of being incorrect. Currently, even if the WRA suspects an amendment is wrong, the refund is paid first and then checked later. And if the WRA later disagrees through an inquiry, it recovers the tax and charges late payment interest. Taxpayer feedback tells us this can feel unfair because the interest could have been avoided if the money had been held until the inquiry was complete. So we're proposing to amend TCMA to give WRA the power to withhold repayments while an inquiry is underway for LTT and LDT. Now, it's important there to note that's a power to do that, and so that won't be exercised in every single case. At the same time, we propose a regulation making power so ministers can extend this to the visitor levy if needed. The aim here is really simple, is to help taxpayers comply with the law easily and fairly whilst protecting the revenues of the Welsh Government. This change would prevent situations where refunds are paid and then reclaimed with interest, and it would reduce collection difficulties for us in the WRA. In terms of safeguards for taxpayers, if the WRA decides to withhold a repayment, that decision would be appealable. Taxpayers could request a review or appeal to the tribunal. And they already have the right to apply to the tribunal to close an inquiry, and that wouldn't be changed. And this amendment adds another layer of safeguards there. Of course, there is a risk that correct amendments could be delayed if the WRA incorrectly flags them at high risk, but repayment interest will accrue on any refund paid back to the taxpayer, and taxpayers, like I said, can always challenge the WRA decision either through review or an appeal. So why are we doing this? Well, we know that some taxpayers already choose to let the WRA retain money as payment on account. But there are cases where amendments are knowingly incorrect or even fraudulent. And in those cases, a power to withhold repayment would protect revenue, especially where recovery later might be difficult. We have considered other options about how to achieve this, but none quite strike the right balance between maintaining self-assessment and protecting revenue. But as part of the consultation, we would welcome any alternative ideas you might have in this regard. If we move on to the next slide then, Claire, we'll have a look at claims for overpayment relief. So Section 30 of the LTTA introduces Schedules 9 to 22, which set out that reliefs can be claimed for certain transactions that would normally be liable for LTT. These reliefs broadly fall into three categories: full relief from LTT, partial relief, or relief where tax is calculated differently or at a different rate. Reliefs are not applied automatically. This is a self-assessed tax, and therefore they must be claimed through a tax return or an amendment to that return. And similarly, there's a similar regime in Landfill Disposals Tax Act where the LDTA provides reliefs for disposals at authorised landfill sites. And where relief applies, tax is not chargeable. The relief must be claimed in a tax return. The WRA currently interprets these provisions to mean that reliefs must be claimed in the initial return or an amendment. And if a taxpayer fails to do so, they cannot later claim overpaid tax under Section 63 of TCMA. And when such claims are made, the WRA relies on Section 67 of TCMA to reject them. In practice, to process these claims, the WRA has been opening inquiries. Even though this isn't required by law, we do this to avoid disputes at a later stage. This approach is inefficient and burdensome for both taxpayers and the WRA. So we propose amending the TCMA to make it clear that the WRA does not need to open an inquiry to reject a claim under Section 67 of TCMA. This would simplify administration and reduce unnecessary work. In terms of safeguards for taxpayers, those normal protections will remain in place. The WRA's refusal to accept an overpayment relief claim will still be an appealable decision. So taxpayers retain the right to challenge decisions while the process becomes clearer and more efficient. And this change matters because it supports one of our core tax policy principles of making tax legislation clear, stable and simple. We'll move on to the next change, change 6, which is all about information notices to check whether relief has been withdrawn. So apologies in advance, a little bit of history here. In 2024, the Land Transaction Tax Act was amended to include a new schedule, and this schedule included a relief from LTT for qualifying transactions of land within a designated special tax site. So the relief works by, well, the relief is withdrawn if during what's called the control period, the qualifying land is not used exclusively in a qualifying manner. The control period starts on the effective date of the transaction for which the relief is claimed, and it ends either 3 years after that date or earlier if there's a final transaction before the 3-year mark. On paper, that sounds relatively straightforward, but in practice, it's quite difficult for the WRA to know whether the relief should be withdrawn. Typically, a return is filed claiming the relief, and then nothing further happens. The WRA can open an inquiry, but only within 12 months of the later of the two dates, either the filing date for the return or the actual date the return was submitted. The problem is there, the WRA might have no reason to open an inquiry within that time frame, or the relief might not be withdrawn until after that 12-month window. So after the inquiry window closes, the WRA could make an assessment under Section 64 of TCMA, but here's the catch, we often don't have enough information to make that assessment. So what's the alternative that's left with us? Well, we could issue an information notice to the taxpayer, but under Section 100 of the TCMA, an information notice can only be issued in two situations, either during an inquiry or when there's a reason to suspect a tax loss. And that second condition is very hard to meet if WRA doesn't have the information or has very limited information. So in practice, these restrictions make it very difficult to properly administer reliefs that include a withdrawal provision. It's a real challenge for compliance, and therefore it's a real challenge for us to ensure the system is working as intended. So apologies about that long sort of history lesson. Looking forward to the proposed changes, we're suggesting an amendment to TCMA. This amendment would give the WRA the power to issue an information notice specifically to check whether the conditions for withdrawing a relief have been met. Importantly, these notices would carry the same protections as other information notices issued under TCMA. That means they'd be reviewable decisions and could be appealed to the tribunal. The VALA has already amended TCMA to allow WRA to issue taxpayer notices without tribunal approval, provided Section 97 requirements are met. And we propose that these new information notices follow the same rules and safeguards for taxpayers. It's also worth noting here that HMRC already has a similar power, and introducing this in Wales would help ensure the correct tax is paid and to protect revenue. We don't expect this to have a wide impact on taxpayers and will maintain safeguards by making these notices appealable. Finally, there's an important time limit. Any notice issued to check whether the conditions for withdrawal have been met cannot be given later than 4 years after the effective date of the transaction. So I'll just cover one more change before handing over to India, and that's around the powers of inspections. We could move the slide deck along, please, Claire. Thank you. Currently, the WRA can enter and inspect business premises, including business assets and documents, to check a person's tax position, but there are strict conditions. An inspection can only happen with the occupier's agreement or with the approval from the tribunal. If the tribunal approves an inspection, the WRA must give the taxpayer 7 days' notice, unless the tribunal agrees that giving notice would seriously prejudice the assessment or collection of tax. And if tribunal approval has been given, the notice must make that clear, because penalties for refusing access only apply where tribunal approval exists. There are also important safeguards here, such as the WRA cannot enter any part of a premises used solely as a dwelling, and we're not proposing any change to that. So what's the issue we're trying to fix here? Well, the challenge is that it's getting tribunal approval for unannounced visit takes time and resources. This can limit the WRA's ability to act quickly, especially in cases when there may be suspected tax evasion. In these instances, the WRA may need to inspect premises without delay to confirm whether the tax is due and to protect the revenue due to the Welsh Government. So we propose an amendment to TCMA, principally under section 103 of the Act, to allow the DCRhT to carry out inspections without seeking tribunal or taxpayer approval in certain circumstances. This additional route would follow a similar rule to HMRC's powers under the Finance Act of 2008. So here's how it would work. Normally, the occupier would still get at least 7 days notice of the inspection. But if a DCRhT committee is satisfied that giving notice would seriously prejudice the assessment or collection of LDT, then contemporaneous notice could be given instead. The tests for an announced visit would remain the same as now. There must be grounds for believing the inspection is required to check a person's tax return. In terms of safeguards, this power would only apply to business premises, not private dwellings. At the start of any visit, the DCRhT would present a notice explaining the purpose of the visit and the taxpayer's rights. And those rights including, pardon me, taxpayer safeguards would remain in place, and the decision to carry out an inspection can still be reviewed and appealed to the tribunal. And if the DCRhT has not sought tribunal and the taxpayer refuses entry, which would absolutely be in their right to do so, there would be no penalty. The DCRhT would then need to seek tribunal approval before proceeding. Ultimately, this change would bring the DCRhT's powers more in line with those of HMRC, but still strike the right balance between taxpayer protection and safeguards and our ability to collect and manage the tax in Wales. So I'll take a pause now. I'll hand back over to India for the next few changes, and I'll speak to you shortly.
Diolch, Joe. So next proposal we'll talk about is a proposal in the paper to provide Welsh ministers power to be able to amend DCRhT's fixed penalties, so that being the failure to file a tax return and also to failure to make payment on time. So this is going to allow Welsh ministers to increase or decrease fixed penalty amounts via secondary legislation. So it's important to note that this proposed change will not mean an immediate change to the penalties regime in TCMA and will require a future government to undertake broader examination of the efficacy of the penalty regime. So a bit of background to this proposal. The thinking has really come from the low value penalties, so your late filing and late payment penalties haven't really changed much over the past 40 years, I think, was where we got back to, and we think it probably goes back even further. And there hasn't really, either at HMRC, Revenue Scotland, or in Wales, been any kind of deep dive into whether or not the values are correct. Are they aligning to their intended purpose? Do they provide an effective deterrent? But as I said, this is all thinking that needs to be done and that we determined that would need to be done before we could propose a change to the penalties within the white paper. So hence why we arrived at giving Welsh ministers the power to do so via secondary legislation. And it should be noted that pursuant to the recently updated Senedd standing orders in accordance with the Legislation Wales Act 2019, that now any secondary legislation that's laid before the Senedd here in Wales has to be done so. You've also got to produce a full explanatory memorandum and regulatory impact assessment so that secondary legislation has greater parity with primary legislation in that regard. So that document would include a full kind of economic analysis and equalities analysis, socioeconomic analysis of any proposed changes, which particularly for a change like this, you would expect to see that greater amount of thinking that's been undertaken before the proposed changes are put before the Senedd. Yeah, so that's that one. We'll move to the next slide. Great, so again, another pretty short one to discuss. So the current rate of late payment interest is set in TCMA at the Bank of England base rate plus 2.5%. So HMRC have recently increased their late payment interest rate and charge on kind of unpaid tax liabilities by 1.5 percentage points from the 6th of April 2025. And one of the concerns that we have is that we think it's quite important to promote consistency across the UK tax system, as exists now within legislation. There's a perverse incentive to pay off some tax debts before others. So the proposed change here is to give are late payment interest parity with HMRC, and namely to change the interest rate to Bank of England base plus 4%. So to bring it up to the same. Yeah, that's that one. Okay, next change. Okay, recalculating interest amounts following an amendment. So currently, interest is calculated for repayments on the original return amount, and pursuant to section 1571B of TCMA, this there's an adjustment in the interest owed if there's an amendment that increases liability, but there's no similar rule that applies when liability decreases. So the proposal is fairly straightforward to amend section 157 TCMA to ensure that any interest payable reflects the amount of WRA collected tax and related penalties that are actually due, rather than that which reflected an original return. So think matters relating to kind of, higher rates relief with LTT, and if there's an amendment, the interest is not something that exists within HMRC and Revenue Scotland's legislation, and we think that this is one of the amendments that we've proposed in the white paper to promote fairness in the tax system. Okay, let's move on. Right, so change 11 is our technical and substantive changes related to taxable disposals and definitions in LDTA 2017. So there's two proposed changes in the white paper relating to LDT. And a bit of a background before we talk through the proposals. At DCRhT, we're very keen to assist taxpayers to get it right the first time and minimise the amount of litigation that can arise from disagreements relating to interpreting the legislation. And the changes we're proposing in the white paper follow on from that. So the proposed changes in our legislation in this space stem from this core aspect of our approach. We say in the white paper that disputes and queries about when a taxable disposal occurs under LDTA can arise when the taxpayers disagree with the interpretation in that legislation. The white paper goes into detail as to where those gaps occur in LDTA, and they're kind of the spaces where there isn't really sufficient clarity as to what is and isn't a taxable disposal. So the problem is that these kind of disputes, they can delay progress towards Welsh Government's circular economy goals and increase costs for taxpayers because this litigation is often quite expensive, and create inconsistencies across the waste sector. Currently, the legislation as a result is leading to different outcomes for taxpayers, and this is due to that lack of clarity that is outlined in the white paper, as taxpayers sometimes have more resource to make these arguments and appeal to the tribunal regarding things like the definition of a landfill cell and the definition of a taxable disposal. And this is delaying that money being collected for the Welsh public purse. So the legislative change we're proposing will effectively flip the way that LDTA works in relation to how it defines taxable disposals, particularly authorised landfill sites. And, because use of material is going to suggest that use of material in landfill cell is prima facie a taxable disposal unless it is material used to form a drainage layer directly above the base of the cell, installation of pipes, pumps, or related infrastructure for managing liquid or gas within the cell, and the use of plant or equipment for waste or environmental management purposes. Now, interestingly, this will mean that LDTA will be aligning to the Scottish Landfill Tax Prescribed Landfill Site Activities Amendment Order 2022, which Scotland did a fairly lengthy consultation on a few years ago. And we are working with colleagues up in the Scottish Treasury in relation to those changes and the efficacy, and that engagement is ongoing. And then also, in a similar vein, so regarding you want to continuously, where possible, provide clarity in LDTA, we're also proposing using the same definition of landfill cell that is currently used in Scottish Landfill Tax Prescribed Landfill Sites Activities Amendment Order 2022, which is namely that a unit or structure within a landfill site formed of an impermeable layer at its base and sides, and save where the cell only contains inert material at the top of the unit or structure. And it's been proposed utilising the same rationale as the first changes on this slide. And with that, I'm going to pass back over to Joe to talk through the final few changes in the white paper.
Lovely, thanks, India. So this is a bit of a land transaction tax marathon, I'm afraid, for the next few slides, and some of these are fairly technical. So I'll try and deal with these as quickly as I can, but giving you the information you need. So we'll start off here with change 12, which is land transaction tax group relief and consideration provided from outside the group. So Schedule 16 of the LTTA provides relief from LTT for intra-group transfers of property where certain conditions are met. Broadly, this means that companies within the same group can transfer property without incurring LTT because the property remains within that group structure. A company is defined as a body corporate, and companies are considered as part of the same group if one is a 75% subsidiary of the other, or both are 75% subsidiaries of a third company. So the current restrictions, which are potentially problematic, can be found in Part 3 of Schedule 16 of the Act, and this Part 3 sets out some anti-avoidance provisions. These rules restrict group relief where arrangements exist that could result in the inquiring company being controlled from outside the group, or where the buyer will cease to be a member of the group. Relief is also unavailable where consideration is provided from outside the group, except for certain mortgage arrangements, which are excluded to avoid catching normal commercial transactions. However, there are situations where consideration comes from outside the group in a way that is not tax avoidance, but results in relief being withdrawn. So in the white paper, we've used the example of Arthur, and I'll replay that example here to you. So in the example in the white paper, Arthur owns two companies, one Alpha and the other Amiga. Amiga owns a residential property valued at £550,000, and Arthur has a director's loan to Amiga for the same amount, and that director's loan funded the purchase and renovation of the property. The property is transferred from Amiga to Alpha at book value, creating an intercompany balance. Arthur then assigns his loan in Amiga against the intercompany balance, crediting his loan account in Alpha. This is a legitimate intergroup transaction. The property remains within the group, but under current legislation, relief would be withdrawn because consideration is deemed to have come from outside the group, so it's coming from it's coming from Arthur. So what's being proposed? We've proposed to amend Land Transaction Tax Act to specify when consideration provided from outside the group will not result in withdrawal of relief, unless that transaction is part of a scheme to save land transaction tax. Essentially, this will ensure that genuine commercial transactions are not inadvertently caught by anti-avoidance rules. In terms of safeguards, the targeted anti-avoidance rule in section 31 remains in place, and this means relief cannot be claimed where the transaction is part of a tax avoidance arrangement. So the integrity of the tax system will be maintained, but it will remove unnecessary barriers for legitimate business activity, which currently are there, and so that's where we are with group relief at the moment. So if we move on to the next change, which is around A to A plus B transactions. A to A plus B transaction is a fairly common type of property transaction. This happens when person A transfers a property currently held in their name into the joint names of A and person B. It's clear that person B, who acquires a new interest in that property, is treated as a buyer under the Land Transaction Tax Act. But the Act is silent on whether person A is also treated as a buyer in this scenario. So why does this matter? Well, the lack of clarity creates legal and tax uncertainty. And it bites particularly in the context of higher rates. So in the context of higher rates, residential property transactions, the rules in Schedule 5 apply when an individual acquires an additional property while already owning one worth £40,000 or more. That's shorthand for the rules. You know, the full rules are there in guidance if you want to read them, but that's the short version. So if A were treated as a buyer in an A to A plus B transaction and A already owns another property, the transaction could fall within the higher rates, even though B alone might not qualify for higher rates. And this leads to unexpected tax liabilities for person B. So to put a bit of colour on this and use the same example that I used in the white paper, we'll take Arwal and Bethan, A and B. Arwel owns 2 properties, a buy-to-let and a home they live in. Bethan owns no property. Arwel wants to transfer the buy-to-let into joint names with Bethan. Bethan pays £200,000 for her share. Under current law, it's unclear whether Arwel is treated as a buyer. If he is, the transaction could attract higher rates, even though Bethan alone wouldn't trigger them. And Arwel isn't actually increasing his share in the property that he's transferred, he's actually decreasing it. So to provide clarity and fairness, we propose introducing a provision into the Land Transaction Tax Act to confirm that in an A to A plus B transaction, person A is not treated as a buyer. This removes the ambiguity we've talked about and ensures that taxpayers aren't unfairly caught by higher rates rules. So move on to reflecting leasehold reform in Land Transaction Tax Act, and this is change 14 on the slides and change 14 in the white paper as well. Again, a little bit of a history lesson, for which I apologise, on collective enfranchisement. So collective enfranchisement is the legal right in England and Wales that allows leaseholders of flats in a building to join together to buy the freehold of that building from the landlord. This right comes from the Leasehold Reform, Housing and Urban Development Act of 1993. When LTT was introduced, guidance was provided that taxpayers should consider their position at the end of the day to determine whether their purchase is liable to the higher residential rates. At the same time, an anti-avoidance rule was added to Schedule 5 of Land Transaction Tax Act to prevent buyers from avoiding higher rates by granting a long lease to a connected person on the day of purchase. That rule has worked well to prevent avoidance, but it may have an unintended consequence. Some collective enfranchisement transactions could be caught by the higher residential rates, depending on the consideration paid by the leaseholders. The collective enfranchisement relief was designed to ensure that leaseholders pay the main residential rates when acquiring the freehold of their home with other leaseholders, but that may not always be happening in practice. So we propose amending Land Transaction Tax Act to make it clear that higher residential rates will not apply to a transaction where collective enfranchisement relief applies. It's worth mentioning here as well, the UK government's also proposing reforms to the Leasehold and Freehold Reform Act, and we're working closely with HMRC and the Ministry for Housing, Communities and Local Government to understand the full impact of these changes on LTT. And so there may need to be some further amendments to this change we're proposing in response to what the UK government are doing. But broadly, the intention is to ensure that people exercising rights of collective enfranchisement do not inadvertently pay the higher rates for their transaction, and they should remain within the main residential rate regime. Moving on then to change 15. Oh, I think there we are, which is nominees and leases. So let's just take a quick look at how nominees and bare trustees are treated under the Land Transaction Tax, particularly for leases. So under Schedule 8 of the LTTA, the general rule is that nominees and bare trustees are looked through for LTT purposes. This means the buyer and seller are treated as the beneficial owners, not the legal owners. A bare trust is defined as one where property is held by a trustee for beneficiaries who are absolutely entitled against trustees, and nominees are treated as bare trustees for these purposes. For leases, different rules apply though. If a lease is granted to a bare trustee, the trustee is treated as both the legal and beneficial lessee. Similarly, if a lease is granted by a bare trustee, the trustee is treated as the lessor, disposing of both the legal and beneficial interest. This rule was introduced in the I forgot what I'm looking for, in SDLT legislation in the Finance Act, where leases granted to or by nominees could be used to avoid tax. The Finance Act 2005 closed that loophole by treating leases granted to or by nominees as chargeable transactions, and that's a set of rules that we've inherited from our predecessor tax, stamp duty land tax. So whilst this change was positive as it prevented avoidance, it also created an exception to the usual transparency principle for nominees and bare trusts, and this can lead to inconsistencies and restrict the availability of certain reliefs for transactions that are genuinely commercial, as they inadvertently get treated as being avoidance. So we propose amending Land Transaction Tax Act to ensure the availability of reliefs is not restricted by this look-through rule for leases. This should make the system fairer and simpler, and it aligns with our core principles of ensuring devolved taxes are clear, stable, and fair. And then my final slide before I hand back to Claire to close the webinar, you'll be glad to know, is on land transaction tax application to the Crown. Now, as a quick look through the attendees of today's webinar, I don't think there's anybody from the Crown attending, so I won't intend spending too long on this one. But essentially, there was a typographical error in the Land Transaction Tax Act when it passed through the Senate the first time in 2017-18, and essentially because of this typographical error, the Crown's rights to request a review or appeal against information notice are unclear. That wasn't the intention of the legislature, and it was the intention of the legislature that the Crown should have these rights. And so we are proposing to fix that typographical error, the full details of which are in the white paper. I won't propose reading out the various sections and subsections that need to get changed. They are there if you're particularly interested, but this is a largely technical correction, but it's there, as I said, to give effect to the original intention of the legislature and ensure fairness and consistency in the application of the law to the Crown. So I'm going to stop there. I'm going to hand back to Claire, who will just close us up and tell us how you can get more involved if you'd like to. So diolch yn fawr iawn i chi gyd.
Diolch India, diolch Joe, thank you very much, and thank you for attending this morning and for your time, really value that. I hope you found it useful. I certainly welcomed the run through of the key changes and was agreeing with some and wanted more detail on others. So I suppose what on that note, we will email you the slides with various links to the white paper and the consultation questions, so you've got more detail, and also a plea really, and we welcome some one-to-one meetings in January with you so we can delve into a little bit more detail on the proposed changes to the Welsh Tax Acts, and then of course that would encourage you and inspire you to get your responses in by the 26th of January. That would be really appreciated by us and Welsh Government colleagues as well. So that's our email there. However, we've got yours, so we'll email you, and then if you can get back in touch, I'm sure India and Joe will really welcome the opportunity to have that conversation.